Now we'll talk about the 5 key economic theoretical principles that undergird or support financial markets and explain how they work and why they work the way they do. Time, risk, information, markets, and stability. Time has value. We are always looking for ways to save time. We are looking for devices and the assistance of people who can save time. There's a psychological aspect to time's value. We value consumption in the future less than the same amount of consumption right now. Time is an essential dimension in the world of finance. Finance is about making trades over time. I lend to you so that I can consume more today. You lend to me so that you can consume more in the future. The fundamental dimension over which trade occurs in the area of finance is time. Now, what links consumption and production in different time periods is the interest rate. The interest rate is like the price of trade over time. Normally, if I want to consume $100 worth of goods today and I borrow from you, I promise to pay you back 1 year from now. I have to pay you more than $100 1 year from now. The extra over and above any compensation for inflation is the reward that you receive for sacrificing present day consumption in favor of future consumption. If you've ever wondered why the interest rate is such a focus of attention, not just in the financial press and the financial industry, but in the newspaper, in regular discussion, it's because the interest rate is the link between today and tomorrow and next year. It's the thing that pulls everything together. If the interest rate is high, it will bias people toward postponing consumption in the future. They'll lend today, receive a big reward for making a loan today, and consume more in the future. If the interest rate is low, people are less likely to consume less today and more willing to consume now. The interest rate affects the decisions of businesses about whether to borrow today or not, or whether to lend today or not. If I can make an analogy like in physics, the force of gravity is this fundamental value that affects everything. Well, in finance, the interest rate is a fundamental price that affects everything. There is a difference, though, between interest rates and the value of the force of gravity. The force of gravity cannot be affected by human beings. The interest rate can be affected by the choices of people and businesses and other agencies in the economic sphere, and the interest rate is often used as a policy tool by governments, by central banks attempting to manage, that's the nice word, or manipulate, that's the less nice word, the choices of individual agents in the economy. Interest rates are going to come up over and over and over again throughout this discussion, this course. So be ready for it. Now, we do talk about interest rates in the plural. Interest rates are different depending on the circumstances of a particular trade. So, for example, you ask me for a loan. I think you are a very reliable borrower, a low-risk borrower. Everything else equal, I will offer you a low interest rate. I will lend to you at a low rate. If, on the other hand, you are perceived to be a high-risk borrower, there's a high risk you'll default, I will offer you a higher interest rate. So the discussion of interest rates involve the concept of a sort of single baseline zero risk interest rate price, and you imagine that that fundamental interest rate gets adjusted for particular contracts based on considerations like risk levels. Finally, probably not something you've heard before, this time dimension angle is why finance and macroeconomics are so closely linked. They both share this time dimension. They both rely on the interest rate as one fundamental price that affects everything. Now, in the case of microeconomics, typically we are operating within a single time period. That's an overgeneralization. It isn't always true, but most of microeconomics, time is not fundamental to the problem in the same way it is for finance and macroeconomics. So let's talk about risk. I've just explained how when we make a contract over time, there's an interest rate that acts as the appropriate equilibrating price, and everything else equal, the higher the risk, the higher the interest rate will be. Now, this is not a real problem for us because we can charge a higher interest rate, and we can also do things like mitigate risk by using insurance. And the insurance will be higher the greater the risk. So far, so good. But what's the problem? Why do things go wrong? Well, they can go wrong because sometimes we don't know the true probabilities when we're dealing with risk. If we don't know the true probabilities that something will go wrong or right, it makes it difficult to zero in on the correct interest rate price. Ever wonder why it's so easy to get car insurance? It's easy to get car insurance because for the auto insurance industry, they have so many millions of data points, so much experience in judging the probability that a particular driver will get in an accident, that they can give very accurate predictions about the relevant probabilities and charge exactly the right appropriate amount of insurance for you or I to pay. So auto insurance works well because it's not a problem for auto insurance companies to know the true probabilities of an accident. Because of the time dimension and uncertainty, information is incredibly valuable in the financial industry, in financial contracts and dealings. The more information you have, the less risk you have. The less risk you have, the better opportunities to make trades. One function of the financial system is to provide information in the form of signals. A super simple example is if your local bank posts the interest rates for an auto loan, a house loan, and so forth. That's a signal to the world that the bank is willing to deal and make a trade, make an arrangement with you or me, provided we can agree on a price. And here's the bank's price, the offer the bank is making. Actually, the bank is acting as the representative of the depositors. The bank's depositors are saying to you and me that they value present consumption less than you or I would, provided that we as borrowers are willing to pay a sufficient price for a loan. Speaking of home loan rates, take a look at this graph. Look at the period for the Great Recession. That is the last gray bar on the right side. Look at the interest rates just before the Great Recession started. Do you think it is just a coincidence that the housing bubble crash and the Great Recession happened right after a little uptick in the mortgage rate, in the interest rate? Look at how current interest rates are at historically low levels. Think that's just a coincidence? No way. The Fed has been very active trying to keep interest rates low in order to stimulate the economy. We'll have a lot more to say about this in future. Organized exchanges approach the information problem from a different direction. They reduce the need to have information. If I buy some stock on a stock exchange, I don't need to know the identity of the person selling the stock. The exchange guarantees the legitimacy of the trade. But what if we have inaccurate information about the institutions themselves, the markets, the banks, the non-banks, the instruments, the fundamentals are themselves uncertain? That's where regulators, regulating agencies, are supposed to be stepping in and providing information, certifying, watching, and ensuring that the system is sound, that the institutions are what they purport to be, what they're supposed to be. We've been talking about financial markets a lot, and it seems like we should take a little time out to talk about what is a market. And the essential thing for determining whether you have a market and why markets are important is that markets generate market prices. Market prices are the result of interactions between traders, between agents. And the prices that come out of that process serve both as data and an incentive. So market prices are a bundle. This bundle signals something important, maybe many things important, about what is happening in this particular industry or this particular market. But it also gives the incentive for agents to act on that information. There's no use having data without an incentive to act, and there's no use having an incentive to act without data. This is the problem in a system with no markets. How do you incentivize people and give them data? How do you give them data but the incentive to act on it? The market solution is market prices. Government or planned economy solutions are clunky and crude by comparison. So this observation that market prices are signals but also incentives is a very profound and important insight that was understood by von Mises, Hayek, and others of the Austrian school. And this was the basis for their argument about why the new USSR, the Soviet Union, could not survive economically. Their economy did not depend or rely on market prices, and therefore it lacked that essential mechanism to reconcile the behaviors of independent agents. The picture below is of the famous libertarian Hayek, and that's the one on the left. Well, he was on the right. Well, never mind. you get it. See you next slide. Stability is a very desirable characteristic of any financial system, and after the 30s and the introduction of deposit insurance, there were no runs or serious disruptions to the United States financial system as a system. But beginning in the 70s, new financial instruments and new sorts of non-regulated, non-transparent institutions began banking activities. And that did not work out very well. More on that in a future time. See you for the next chapter.